90% of people who try swing trading lose money in their first year, not because the strategy is broken, but because they skip the fundamentals that actually matter.
Today, I am going to walk you through exactly how to swing trade the right way as a complete beginner. From understanding what swing trading actually is, to the two core strategies that professional traders rely on, to the mistakes that will drain your account if you do not address them early. By the end of this video, you are going to have a clear roadmap that most beginners never get. So let us get into it. First, let us define what we are actually talking about. Swing trading means holding a position for longer than a single trading session. That could be a couple of days, a couple of weeks, or in some cases even a few months, depending on the setup. You are not trying to catch every tiny price fluctuation throughout the day like a day trader or a scalper would. Instead, you are aiming to capture a bigger directional move on a higher time frame. And your primary chart is usually the daily chart rather than the 1-minute or 5-minute chart. Now, here is why this matters so much for beginners specifically. When you are day trading, every single candle matters. Every headline matters. Your attention cannot waver for even a second, and your nervous system is essentially running at full capacity all day long. Swing trading operates at a completely different pace. You can spend your mornings doing research, building watch lists, identifying key levels, setting your risk parameters, and then letting the trade develop on its own. Instead of making 50 rapid-fire decisions every hour, you might only need to make 1 or 2 meaningful decisions in an entire day. That slower pace is not a weakness. For most beginners, it is actually a massive advantage because it dramatically reduces the impulsive mistakes that blow up accounts. There is another huge benefit that beginners overlook, and that is scalability. When you are aggressively trading intraday, your strategies can become limited by liquidity and execution speed. As you try to increase your position sizes, slippage eats into your profits, and your edge starts to shrink. Swing trading largely eliminates that problem because you're targeting bigger moves over longer periods. A few pennies of difference on your entry or exit barely matter when you're trying to capture dollars on the overall move. This means as your account grows and your skills develop, swing trading can grow right alongside you without running into the same ceiling that short-term trading often hits. But I want to be completely honest with you. Swing trading is not all sunshine. There are real downsides you need to understand before you commit to this approach. The biggest one is overnight risk. When you are a day trader and something terrible happens after the market closes, you are safe because you already sold everything. As a swing trader, you wake up and your stock could be down significantly because of an earnings miss, a geopolitical event, or some unexpected news that dropped while you were sleeping. That gap risk is real, and it is something you have to factor into every single position you take. There is also a psychological challenge that surprises a lot of people. Even though swing trading is less intense during the trading day, you are carrying positions in your head constantly. You might find yourself checking quotes at dinner, worrying about your positions before bed, and feeling anxious about what the morning will bring. So you are trading one type of stress for another. Understanding that trade-off up front will help you manage it much better. So who is swing trading actually ideal for? There are 3 main groups. First, if you have a full-time job, a family, or any other commitment that prevents you from watching screens all day, swing trading lets you participate in the market without sacrificing your entire schedule. Second, if you have tried day trading and found it mentally exhausting, swing trading offers breathing room. You can step away, think clearly, and avoid the constant fight or flight state that burns people out. Third, if you are someone thinking long-term about growing your capital, the scalability of swing trading makes it an excellent vehicle for compounding wealth over time. Now let us talk strategy, because this is where most beginners overcomplicate things and end up confused. The 2 main approaches that professional swing traders rely on are mean reversion and continuation plays. Let me break down each one. Mean reversion is built on one simple idea. When a stock moves too far too fast in one direction, it tends to snap back toward a more balanced price. Think of it like a rubber band. The further you stretch it, the harder it snaps back. These setups become powerful because of emotional exhaustion in the market. When fear or greed pushes a stock to an extreme, participants stop making rational decisions. Sellers panic, buyers disappear, and the price overshoots in one direction. Eventually, there simply are not enough sellers left, and that is when the reversal begins. The key here is that just because a stock has dropped a lot does not automatically make it a buy. You need to look for signs that the selling pressure is genuinely exhausting itself. Massive volume spikes after a sharp and accelerating decline, price action that starts to stabilize, and a general sense that the panic has reached its peak. When those conditions align, you can enter on what some traders call the right side of the reversal, placing your stop below the recent lows and trailing it, using prior daily bar lows as the position moves in your favor. The second strategy is continuation plays, and this one is particularly interesting for beginners because it aligns with a principle that is deeply counterintuitive. Stocks that are already strong tend to keep getting stronger. Instead of betting against an extended move like you would with mean reversion, you are betting that a powerful trend has more room to run. What you want to look for is a stock that has made an explosive first leg, something in the range of 15 to 20% or more, and then pulled back into a tight consolidation. Ideally, that consolidation is shallow, lasting fewer than 10 days, with decreasing volume and narrow range candles. This tells you that the buyers who drove the initial move are still in control, and that sellers are not stepping in aggressively. When the stock breaks out of that consolidation on renewed volume, that is your entry signal. Your initial stop goes below the consolidation range, and you can trail it using the lows of prior daily bars or a moving average like the 20 period on the daily chart. One thing that makes continuation setups especially appealing is that they align with how institutional money actually moves markets. When big funds decide they need exposure to a particular sector or theme, they do not buy for 20 minutes. They accumulate positions over weeks and sometimes months. That sustained buying pressure creates the kind of trends you want to ride as a swing trader. Now here is where I need to give you the single most important piece of advice in this entire video, and it comes down to position sizing. This is the mistake that ruins more beginning swing traders than anything else. When you are day trading, your stops might be very tight, maybe 50 cents or $1 away from your entry, so you can afford to take a larger position. Swing trading naturally requires wider stops because the daily chart structure is wider. If your stop on a swing trade is $3 or $4 away instead of 50 cents, but you keep the same position size you would use for a day trade, you are taking on massively more risk than you realize. The math is straightforward. If your stop is 3 times wider, your position size needs to be roughly 3 times smaller to maintain the same dollar risk per trade. This sounds obvious when you hear it explained. But, emotionally, traders hate reducing their size because it feels less exciting. Smaller size means smaller potential profits on any individual trade. But here is the reality. If you are oversized relative to your stops, you will not be able to tolerate the normal fluctuations that happen within a perfectly healthy swing trade. You will panic out early, micromanage the position, and sabotage your own system. Proper sizing is what allows you to actually stay in winning trades long enough for them to work. Let me give you a few more practical tips that will save you a lot of pain. First, start with a demo account or paper trading before you risk real money. I know that sounds boring, and I know you want to jump in immediately, but the purpose of simulation is to build competence without financial consequences. You can test setups, practice your entries and exits, and figure out whether your approach actually has an edge before your real dollars are on the line. If you cannot make money consistently in a simulated environment with proper discipline, adding real capital will only magnify your weaknesses. It will not magically fix them. Second, keep a detailed trading journal from day one. Every trade you take, write down why you entered, where your stop was, what your target was, and how the trade actually played out. Over time, this journal becomes your most valuable tool because it reveals patterns in your behavior that you would never notice otherwise. Maybe you consistently exit winners too early. Maybe you ignore your stops on losers. Maybe certain setups work great for you while others consistently fail. Without a journal, you are flying blind. Third, focus on stocks that are actually in play. What that means is you want to trade names that are attracting volume, attention, and active price discovery. These are the stocks where opportunity lives because they have the participation needed to generate meaningful moves. Trading low volume, forgotten stocks that nobody cares about is a recipe for getting stuck in positions that go nowhere. Fourth, do not chase excitement. This is a trap that beginners fall into constantly. They see some stock up 200% in a day and think that is where the money is. But those situations often come with extreme risk, poor liquidity, and the kind of volatility that can wipe out a beginner in minutes. You are far better off trading setups with smaller percentage moves, but highly repeatable positive expected value. Consistency beats fireworks every single time. And finally, do not rush the process. I know that is hard to hear when you are eager to build your account, but desperation is one of the worst emotional states for making good trading decisions. The more pressure you put on yourself and the shorter your timeline for success, the worse your choices become. Trading is a skill that compounds over time, just like the money itself. The traders who survive long-term are not the ones who post incredible returns in their first month. They are the ones who stay in the game long enough to become genuinely skilled, and once that skill is there, the money follows naturally. So to recap everything we covered today, swing trading means holding positions for days to weeks, primarily using the daily chart. It offers a healthier pace, better scalability, and fewer impulsive mistakes compared to day trading. But it comes with overnight risk and its own psychological challenges. The two core strategies are mean reversion, where you trade snapbacks from emotional extremes, and continuation plays, where you ride strong trends through breakout consolidation patterns. Your position sizing must match your time frame. Your stops must align with your chart, and your expectations need to be realistic. Start in simulation, journal everything, trade stocks that are in play, and give yourself permission to learn at a sustainable pace. If this video helped you understand swing trading better, make sure you hit that subscribe button and drop a comment letting me know which strategy you are most excited to try. I will see you in the next one.